Good afternoon, everyone, and welcome to the July version of Making Sense of the Markets with Chris Kerlow and Team LWC. Thank you to everyone for taking time out of your day to join us. If you have any questions during our presentation today, please write them in the chat, and I will ask them to Chris if they are timely. Otherwise, we'll get back to you directly or address it in our next MSOM. This month's edition is titled Goldie Drops, where Chris will walk us through the latest on the markets, gold, and the recency bias. Take it away, Chris.
Thanks, Adam. Hope everyone's having a nice start to their summer. Just entering presentation. We titled this presentation Goldie Drops, as we're seeing drops in the market, as well as kind of gold rallying, a trade that we put on earlier this month. We'll touch on that and much more in this month's Making Sense of the Markets. Obviously, the story continues around inflation. Headline inflation came in a little bit lower than expected for June, which is a welcome sign after a challenging tick up in May, but that has the market betting on the Bank of Canada continuing the rate hike regime next week on July 24th, with an overwhelming majority predicting a cut, continuing to see softness in the labor market here in Canada, with our unemployment rate rising to 6.4% on a year-over-year basis. Typically, a leading indicator in almost all recessions is that unemployment rate continuing to tick higher. It's something we're looking for on the United States side, looking at payrolls data, which tends to be a little bit more timely. The unemployment rate is a trailing figure, tends to be a little bit too late by the time you start to see movements in that. The fact we are seeing it here in Canada is a little discouraging in a sense of our economic growth is continuing to weaken. And there isn't a technical recession here in our country, but the chart on the bottom left is showing the pain that we are feeling as individuals as our per capita per GDP is falling. You can see that by the black bar in the chart on the bottom left, while in the United States, it continues to rise. So what does that mean? GDP, gross domestic product, is how much we generate as revenue as a country, divided by the number of people. And although that has been increasing, we are also increasing the denominator of that equation, the people, by our very friendly immigration regimes and birth rates. And so we aren't making quite enough money to continue the growth per capita like we have seen in the United States. Turning our picture south of the border, Jerome Powell, in his latest appearance in front of the Senate and Banking Committee, clarified that he's not waiting for that 2% inflation, although it is their target, to start cutting rates. They will likely begin cutting in September. About 94% of Fed watchers believe that we are going to see that first cut then, and that's the time that I've been predicting for quite some time now. Notably, again, we saw the Consumer Price Index and the PCE, the Fed's favorite inflation measure, fall again in May to 2.7%, getting closer to their range. They have more of a hard target at 2. We kind of have a band here in Canada that goes up to 3. Typically in this regime, when you start to see rate cuts, it's the time when small cap finally starts to outperform. And we have leaned into that trade. We actually added the Fidelity Small Cap Global Opportunities Fund. Fantastic opportunity there. We've seen a huge divide, about a 2 standard deviation, basically a big gap in the valuation discount between small cap and large cap stocks. It's only been this wide a couple of times in history, including the tech crash in right before the tech crash in the late 90s and back in the 1970s. So we think it's an opportune time. In particularly, small cap stocks are less tech focused, more industrials and some financials and some in the manufacturing space. So we think that there's a good opportunity there. We put this on a few weeks ago, and lo and behold, the last few days, we've seen a large outperformance from the Russell 2000, which is kind of the US small cap sector or index, versus the S&P 500, as well as a catch-up trade from the S&P 500 equal weight index, which is an equal weight of all the companies inside of it, versus the market cap index, which is the one most widely publicized that as many of you would know, is being dragged higher by that Magnificent Seven, which is the 7 largest companies in the world, formerly called Fangman. I could list them off from that, which is Facebook, Amazon, Microsoft, NVIDIA, Apple, and Google, now Alphabet, but all of which are in and around that $1 trillion club. Tesla got tucked in there during this phase. We've seen a comeback in that stock, a name we've owned for the past half a year. Like, we enjoy seeing that move higher. Late, about early last 2 weeks ago, on the early July, we actually took some profits from Tesla and NVIDIA, as both have continued to march higher, producing concentration risks in our portfolios. We take a very disciplined regime. When stocks get to a certain percentage of the overall portfolio, we take some profits, and as well as when they start to break down, we take some profits in both those situations, which we have been seeing from that space, and it's been a decent accumulation of cash. We just put those proceeds into a cash program, which is yielding over 5%, which has been the right play in the last couple of weeks. It is hard to trim your winners, but we'll talk about that on the last slide. Where we are seeing really encouraging signs in the market is on the manufacturing side. That bodes well, in particular, for international stocks that are supplying the robust US economy, as well as here in Canada and Mexico. That had gone into a bit of a doldrum following COVID-19, as inventory levels stocked up, as people just weren't buying as much as they were previously. Encouragingly, you can see that in the chart on the bottom left here. That is inventory levels. You can see them building extremely high through 2020, 2021, which caused a inventory glut. Not good for manufacturing. You're not going to build more widgets when you got lots of widgets in the warehouse. We're starting to finally see that come back. You could see as that has now starting to finally be replenished, with those lines moving higher. That has coincided with a pick back up in the manufacturing center. 12 out of 16 manufacturing centers posting price manager indexes over 50. Basically means they're expanding. Over 50 is expansion, under 50 is contraction. Encouraging from an overall global economic standpoint, and why we added a little bit during this most recent rebalancing to our international position, looking for companies outside of North America. Again, good valuation discount and opportunity to de-risk the portfolios from some of those higher flying stocks that go up quickly, but down in most cases just as quick. And you're seeing that here, not so much in the stock prices, but you can see the earnings of the Magnificent Seven, those names I alluded to just a few minutes ago, starting to taper off. You can see that at the bottom side of this chart. It had been rising pretty fast since 2022, and it's allowing kind of the year-over-year sales growth of the rest of the companies to catch up and take place. That gap had been quite wide for some time. That earnings growth expectation has led to a lot of the outperformance in those names, but an area that we've done well in and are starting to take a little bit off the table. We still remain long in that part of the market, but you are starting to see that market breadth become concerning, and as contrarians, we're kind of buying that dip per se, but 2/3 of stocks are in an uptrend. That's a positive sign that things are going well for the market. And a lot of what I've read and believe as well is that the catch up between those high flying stocks and kind of the rest, the 493 other stocks in the S&P 500, is going to be in a downdraft, meaning they're going to catch down to those stocks that maybe just don't fall quite as much during the next pullback, which is what we're somewhat positioning for by moving some chips around into international and small cap, and taking some of our credit risk off the table. One of the other ways we're defending portfolios is we added a position into the Dynamic Precious Metals Fund. This is run by a gentleman named Robert Cohen. Robert's a bellwether in the industry. I've been covering him since the acquisition of Scotia, purchasing Dynamic back when I was just sharpening my teeth at Scotia. He's been doing this his whole career, one of the best in the business. You could look at it from the peer group, which he outperforms dramatically, and of which he's a large part of, and you take him out of there and the gap is quite astonishing. Really strong manager of picking companies, particularly in the gold space. Gold, as many of you would know, is seen as a store of value for investors, alternative to kind of traditional fiat currencies. One of the issues that we've had since the pandemic is a buildup of sovereign debt. We're showing that here with the debt obligations by countries around the world, and the requirement for refinancing those obligations has only gone higher in recent years. That's going to cause an increased debt burden for those companies as they need to refinance at what is now higher rates. And there is a projected borrowing rise of 15.8 trillion US dollars in this year alone. All of that, more dollars in the market, higher price for gold. Just to analogize that a little bit more simply, if the US government, if you had a gold bar in your house that was worth $2,500 today, the US government gave everyone in the United States $1 million tomorrow, and someone asked you to sell your bar for $2,500, you're going to tell them to go kick rocks, and you'll wait for a better offer because there's more dollars out there, meaning your gold is worth more. So that is a positive case for gold. There's increased obvious geopolitical concerns, what we see and what we don't see. We saw that rear its head this week in the United States, and then obviously the ongoing conflict in Russia, the Ukraine, the Gaza Strip. All of that is just one bad day away where gold is a safe haven trade. So we see further upside from that happening there. And lastly, there is a seasonality component to gold. You can see that in the chart on the bottom right. Tends to do its best during the back half of the year. So we thought now is an opportune time. We bought this about a month ago when gold had pulled back, with the plan of adding more if we saw a further pullback. It doesn't look like we're going to get that, and might just be locked in at this kind of 2/3 position, as we would define it at Team LWC. Lastly, as we usually do, touching on a little bit of behavioral finance. This week, we're talking about the recency bias, which is prone into all of us in investing, and not only investing in our day-to-day lives. We often put more emphasis on the most recent data than data that has come before it. That has people, roaring into this tech trade and possibly bidding it up past natural belief. From a real life experience back in 1975, when the blockbuster Jaws was first released, we saw an extreme decrease in the amount of people swimming in oceans in the United States that following year, not because shark attacks or shark populations grew, just because they had new information that trumped the old information in their mind. It's something we see over and over again in investing, and one of the best ways to defend that is with a defined regimented process like we have at Team LWC. As we've institutionalized our investment management approach, we aren't out here just throwing darts, investing on emotion. We really are working around a thought out, defined system, time tested, that we continue to improve and refine over time.